the ability to service the note, right? If I borrow 80%, what am I investing in there to make sure that I'm servicing? And if I don't, what, kind of like a margin call, what happens? And then, does the whole thing kind of collapse on itself? And you'll be smart about the amount of, debt that you're taking on. It's just kind of thinking strategy there. Any strategy on that, Robert?
Yeah, I would say that you would ultimately be as strategic there as you would be with your portfolio in general. In other words, you would keep some cash reserves in order to make sure that you could always service the note, which is the important part.
Mm.
Again, the differential is not typically huge between the interest that you're paying and the interest that your underlying asset is generating. But of course, you would want to make sure that you had cash reserves, just as you would in any prudent portfolio. I would also say that typically speaking, what our sellers are doing is they're then using that liquidity to buy other assets. And so what they're finding is that the investment portfolio, including your qualifying replacement property and then what you're using it for subsequently, is dramatically outperforming the cost of the underlying note.